Companies around the world are operating in a very difficult economic environment, and that's why companies would need funding for several reasons. And here companies' financing options would be either internal or external. However, borrowing from external commercial lenders at high interest rates would not be the best option that most companies would proceed with. Well, so one of the best approaches here when we have a group company structure is to proceed with the financing internally through an intercompany loan. And here, some businesses would move funds informally between different companies within the group without being aware of the related tax implications or tax risks. And that's what we are going to discuss today within this video. Hello everyone and welcome to the Tax Gate. Hit the subscribe button and let's get started. At the beginning, let's briefly understand what does it mean to have an intercompany loan. Intercompany loans are loans from one entity to another entity within the same group company. So, it is established between two related companies where the borrowing entity and the lending entity are part of the same group. And here the lending entity pays the loan principal amount to the borrowing entity at the start of the loan period, and then the borrowing entity repays the principal amount plus interest to the lending entity at the loan maturity date. Good. That was briefly the definition of the intercompany loan, and now let's understand what are the tax implications that would be associated with intercompany loans. However, at the beginning, we should importantly highlight that each and every jurisdiction would have its own tax treatments dealing with intercompany loans. However, what we are going to do is just to highlight the most likely scenarios that we would be facing dealing with intercompany loans. Well, let's start with the most important point here, which is the transfer pricing implications. Talking about the transfer pricing aspect, here we would highlight that intercompany loans are one of the main focus points for the tax authorities around the world, as this type of transactions are considered being one of the high risks from a tax perspective. The interest rate applied to the loan transaction is one of the most critical terms within any intercompany loan agreements. Within the intercompany loan, the interest rate would be considered based on all the terms and conditions as included within the related agreement, and here just to ensure that the applied interest rate is arm's length, it would be necessary to ensure that the applied interest rate is reflecting the same behavior that would be considered by a third party in market circumstances as well. It is important to ensure that the intercompany loan terms are consistent with the arm's length principle and reflect the market conditions in order to avoid any transfer pricing adjustments upon tax audit phase. Good. Now let's move to another important aspect here, which is the interest deductibility from a corporate tax point of view. In general, interest expense incurred against business activities should be tax deductible. However, some specific interest expenses against the provided loans could be limited, or the tax deduction could be capped to a specific percentage according to the law under the thin capitalization rules. So, as we were saying, the thin capitalization rules limit the amount of tax deductions available for interest expenses. Typically, interest deductibility would be restricted if a measure of the company's debt relative to its assets or equity exceeds a certain ratio as determined by the law, and here interest payable exceeding the mentioned percentage is not tax deductible. Also, this is in line with the OECD's recommendation on the limitation of interest expense deductions BEPS Action 4, which restricts a taxpayer's deductible borrowing costs to generally 30% of the taxpayer's earnings before interest, tax, depreciation, and amortization. Well, that was for the limitations of the interest deductibility from a corporate tax perspective, and now let's cover one of the most important points here, which is the withholding tax aspect. For the withholding tax implications, here we would highlight that interest payments associated with the intercompany loans and made to a foreign related parties are normally subject to offshore withholding tax. And here we should highlight that the withholding tax rate would be applied based on the local laws. However, in case a double tax avoidance treaty was concluded between the countries where both the loan provider and the loan recipient are resident, then a reduced withholding tax rate may be in place. Well, and now finally with the indirect tax implications, either VAT or GST. Once again, taking about the interest payments associated with the intercompany loans would be subject to either VAT or GST reverse charge mechanism, depending on the jurisdiction where the interest payer is resident. And here the loan recipient would calculate the indirect amount upon processing the interest payments and then to be paid to the relevant tax authority. Also, the loan recipient in this case would be entitled to recover the paid indirect amount either VAT or GST. However, as we highlighted within one of our previous videos, that in some jurisdictions full input VAT deduction would not be allowed, and accordingly the paid amount would be considered as cost at the loan recipient level. Good. That was briefly the indirect tax implications. And now once again, and as highlighted at the beginning of our video, that each and every jurisdiction would have its own tax treatments dealing with intercompany loans. Those are the most likely scenarios that we would be facing dealing with intercompany loans, which would materially impact the business. Like and subscribe if you would like to see more videos, and thanks for watching TaxGates.